Hey guys, what is up? Welcome back to the channel. In today's stock market explained video, I'll be taking a look at what is a stock market crash. I'll be going through with you the meaning of a stock market crash, take a look at some examples in history of stock market crashes, the percentage decline in these stock market crashes and more. Early in 2020, we experienced a stock market crash due to the pandemic. From this article, we see that the Dow drops nearly 3,000 points and the S&P 500 fell by more than 11%. And the Dow experienced its worst first quarter in history by declining about 23%. And this is reflected in the price charts. For the S&P 500, there was a steep decline in prices, where prices declined by about 35% from peak to trough. So what we experienced in the stock market in early 2020 was a stock market crash. So what is a stock market crash? A stock market crash is defined as a fast and steep decline in stock prices. And the percentage decline in stock prices is in the double digits. While there are no hard and fast rules on what constitutes a stock market crash, I have found that this definition gives a good representation of what a stock market crash is. Okay, now that we know the definition of a stock market crash, let's take a look at some examples in history of stock market crashes and see whether there are any commonalities between these stock market crashes, especially in the events leading up to them. These are some examples of stock market crashes in history, and we'll take a look at 4 of them. The Great Depression in 1929, Black Friday in 1987, Great Recession in 2008, and the most recent, the pandemic crash in 2020. The Great Depression, which happened in 1929, was one of the worst stock market crashes in history. Not only did the stock market experience its worst decline in the Great Depression, but it also lasted for long periods of time. The Great Depression took place in the later years of the 1920s. But during the earlier half of the 1920s, the US economy was doing really well in the first half of the 1920s. And it was doing so well that those years were called the Roaring Twenties. Unemployment was low, ownership of automobiles were also increasing, and jobs were also being created. So all in all, in the earlier part of the 1920s, the US economy was doing well. And this created an environment where speculating in stocks became a national pastime. However, these good times didn't last long. The stock market peaked on the 3rd of September 1929. And between that time to 8 July 1932, the stock market declined by a whopping 89.2%. So the stock market lost almost 90% of its value during that period of time. And to provide further example of the gravity of this stock market crash, it was not until November 23rd, 1954 that the Dow reached back its previous peak. If you do a simple calculation, that is 25 years later, or a quarter of a century later. And that is why the Great Depression in 1929 is widely considered as one of the worst stock market crashes in history. This is the price chart for the S&P 500 during the Great Depression. The stock market peaked at around August 1929. And from there it was downhill all the way until around May of 1932. And this drop, which we have mentioned earlier on, wiped out about 90% of its value. Even after more than 10 years in 1950, the stock market has not managed to reach its previous peak in August 1929. So that is the Great Depression of 1929. The next stock market crash that we'll be taking a look at is the Black Friday crash in 1987. In the 5 years leading up to 1987, the Dow Jones more than tripled its value. Furthermore, during these 5 years, the stock market was always in a bull market, and never did it once venture into bear market territory. And in just 1987 alone, the Dow rose by more than 43%. So the stock market was certainly doing very well leading up to 1987. However, on October 19, 1987, the Dow fell by 22.6% in just a single day. It was the largest one-day percentage drop in history. So just imagine, in one day, the Dow lost more than 1/5 of its value. And it took the Dow 2 years to claw back its losses. This is the price chart for the S&P 500 during the 1987 crash. On the charts, you'll see that there was a steep decline in stock price over this period of time. And it took quite some time for it to claw back its losses. The next stock market crash that we'll be taking a look at is the Great Recession in 2008. And this stock market crash was definitely one of the worst in history, perhaps only behind the Great Depression in terms of severity. One of the main causes of the Great Recession was the housing crisis and the housing bubble. During that time, there was an explosive growth of subprime mortgages. What subprime mortgages were was that they were loans made to people who had little or no ability to pay back. While it might seem really incredulous that such loans were being made back then, they did actually took place in the 2000s. So loans were made available to people even if they had low credit score. And because home ownership was high back then, rising housing prices and easy credit led people to overextend themselves. So they continued to borrow more and more. And at that time, it really seemed like everyone was enjoying prosperity. This is a chart showing the median sales price of houses sold in the US. And during the 2000s, it only increased over time. However, this mirage of a prosperity did not last long. And when it did finally came to an end, things turned nasty real fast. The stock market declined by more than 50% from peak to trough. And it took the Dow a further 5 years just to recover from its August 2007 peak. So this is the price chart for the S&P 500 during the Great Recession. Stock prices took a nosedive and only managed to recover its peak 5 years later. The most recent stock market crash is the pandemic crash in early 2020. Let's take a look at the events that led up to this stock market crash. So the 2020 stock market crash came on the heels of after a decade of economic prosperity. In fact, during that period, global unemployment was at its lowest. In the US, unemployment rate was at 3.8%, which was the lowest on record post-World War II. However, after the pandemic hit, unemployment rate in the US jumped all the way to 14.4%, making it the highest on record post-World War II. Also leading up to the 2020 stock market crash, the stock market experienced the longest bull market run in US history. This bull market run lasted for about a decade, or 10 years, starting way back in March 11, 2009. However, when the pandemic hit, stock markets declined substantially. In fact, the Dow Jones fell by about 28% in just a single month, between February 11 and March 12, making it the fastest fall in global stock market history. If you take a look at the price chart for the S&P 500 in the early part of 2020, the S&P 500 declined by about 35% from peak to trough in just about a month or so. So far we have went through 4 different stock market crashes, and there was certainly some common characteristics leading up to these stock market crashes. For all these 4 stock market crashes, the stock market and the economy were generally doing well leading up to the crashes. While good performance in the stock market and economy might not necessarily lead to a stock market crash, we have seen that stock market crashes tend to happen after periods of economic prosperity. So if there's one thing to take away, we know that good times in the economy and the stock market typically do not last forever. So if you're watching this video down the road, and if you are in a long and extended period of prosperity, then perhaps it's good to start paying more attention to a possible stock market crash in the future. While I don't want to be bleak, this is just the reality that we are living in. So if you have enjoyed the bleak ending to this video, smash that like button because it will really help the channel grow and allow me to produce more content such as this. And if you are new to this channel, don't forget to subscribe because each week I release one new video about investing, trading and the stock market. I'll see you in those other videos. To your financial success.